Section 15 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 4 concluded. Financial sector growth. I think we overdid finance versus the real economy. For about 2 decades, beginning in the early 1980s, the financial sector grew faster than the rest of the economy, rising from about 5% of gross domestic product, or GDP, to about 8% in the early 21st century. In 1980, financial sector profits were about 15% of corporate profits. In 2003, they hit a high of 33%, but fell back to 27% in 2006 on the eve of the financial crisis. The largest firms became considerably larger. J.P. Morgan's assets increased from $667 billion in 1999 to $2.2 trillion in 2008, a compound annual growth rate of 16%. Bank of America and Citigroup grew by 14% and 12% a year, respectively, with Citigroup reaching $1.9 trillion in assets in 2008, down from $2.2 trillion in 2007, and Bank of America, $1.8 trillion. The investment banks also grew significantly from 2000 to 2007, often much faster than commercial banks. Goldman's assets grew from $250 billion in 1999 to $1.1 trillion by 2007, an annual growth rate of 21%. At Lehman, assets rose from $192 billion to $691 billion, or 17%. Fannie and Freddie grew quickly too. Fannie's assets and guaranteed mortgages increased from $1.4 trillion in 2000 to $3.2 trillion in 2008, or 11% annually. At Freddie, they increased from $1 trillion to $2.2 trillion, or 10% a year. As they grew, many financial firms added lots of leverage. That meant potentially higher returns for shareholders and more money for compensation. Increasing leverage also meant less capital to absorb losses. Fannie and Freddie were the most leveraged. The law set the government-sponsored enterprise's minimum capital requirement at 2.5% of assets plus 0.45% of the mortgage-backed securities they guaranteed. So they could borrow more than $200 for each dollar of capital used to guarantee mortgage-backed securities. If they wanted to own the securities, they could borrow $40 for every dollar of capital. Combined, Fannie and Freddie owned or guaranteed $5.3 trillion of mortgage-related assets at the end of 2007, against just $70.7 billion of capital, a ratio of 75 to 1. From 2000 to 2007, large banks and thrifts generally had $16 to $22 in assets for each dollar of capital, for leverage ratios between 16 to 1 and 22 to 1. For some banks, leverage remained roughly constant. J.P. Morgan's reported leverage was between 20 to 1 and 22 to 1. Wells Fargo's generally ranged from 16 to 1 and 17 to 1. Other banks upped their leverage. Bank of America's rose from 18 to 1 in 2000 to 27 to 1 in 2007, when Citi bought off-balance sheet assets onto the balance sheet. More than other banks, Citigroup held assets off of its balance sheet, in part to hold down capital requirements. In 2007, even after bringing $80 billion worth of assets on the balance sheet, substantial assets remained off. If those had been included, leverage in 2007 would have been 48 to 1, or about 53% higher. In comparison, at Wells Fargo and Bank of America, including off-balance sheet assets, would have raised the 2007 leverage ratios 17% and 28%, respectively. Because investment banks were not subject to the same capital requirements as commercial and retail banks, they were given greater latitude to rely on their internal risk models in determining capital requirements, and they reported higher leverage. At Goldman Sachs, leverage increased from 17 to 1 in 2000 to 32 to 1 in 2007. Morgan Stanley and Lehman increased about 67% and 22%, respectively, and both reached 40 to 1 by the end of 2007. Several investment banks artificially lowered leverage ratios by selling assets right before the reporting period and subsequently buying them back. As the investment banks grew, their business models changed. Traditionally, investment banks advised and underwrote equity and debt for corporations, financial institutions, investment funds, governments, and individuals. An increasing amount of the investment bank's revenues and earnings was generated by trading and investments, including securitization and derivatives activities. At Goldman, revenues from trading and principal investments increased from 39% of the total in 1997 to 68% in 2007. At Merrill Lynch, they generated 55% of revenue in 2006, up from 42% in 1997. At Lehman, similar activities generated up to 80% of pre-tax earnings in 2006, up from 32% in 1997. At Bear Stearns, they accounted for more than 100% of pre-tax earnings in some years after 2002 because of pre-tax losses in other businesses. Between 1978 and 2007, debt held by financial companies grew from $3 trillion to $36 trillion, more than doubling from 130% to 270% of GDP. Former Treasury Secretary John Snow told the FCIC that while the financial sector must play a critical role in allocating capital to the most productive uses, it was reasonable to ask whether, over the last 20 or 30 years, it had become too large. Financial firms had grown mainly by simply lending to each other, he said, not by creating opportunities for investment. In 1978, financial companies borrowed $13 in the credit markets for every $100 borrowed by non-financial companies. By 2007, financial companies were borrowing $51 for every $100. Quote, "We have a lot more debt than we used to have, which means we have a much bigger financial sector," said Snow. "I think we overdid finance versus the real economy and got it a little lopsided as a result," unquote. End of section 15 and of chapter 4.